Hey there, everyone. Welcome to Chart This with Dave Keller. It's Tuesday, April 15th. Welcome to the show. My name's Dave Keller. Pleasure to bring you a brief market update and chart commentary and questions answered from a beautifully sunny and clear Redmond, Washington. I'm talking highs in the mid 60s, not a cloud in the sky, no rain. It is very un-Seattle-like. I'm told in the next couple days we'll get back to some normal April weather for this part of the country, but man, are we enjoying it right about now. The market's not really showing the love. Overall, not a bad day, but generally the market drifting lower today, as you'll see when we get to the market update. Earnings starting today, right, and really started last Friday. We're continuing to see a string of earnings. Not too bad. The problem is we're starting with financial firms, which arguably, out of all of the sectors that we're going to hear from in this earnings season, probably the companies that have the most to be thankful for would be banks, who are seeing record trading volumes and all sorts of panicked, emotion-driven trading activity on their brokerage side. So that's good. I think when we get to some of the consumer names and others, we may see a little different complexion to this earnings season. We'll see what happens over the next couple weeks. We are live streaming on Facebook, LinkedIn, YouTube, and X, and I appreciate you tuning in live from wherever. Ruben, buenos dias, welcome, and thanks for tuning in from Spain and others. I appreciate you coming in live. As we go through the update, please drop questions as we go along, and at the end of the episode, I'll try to take a question or two before we wrap for the evening. Anything we don't get to, we'll put into the Chart This mailbag. We're planning an all mailbag episode on Friday. Those Friday episodes have been a lot of fun. Gives us a chance to take a little more time, have some thoughtful responses to all of the different great questions that we're receiving through the course of the week that we just can't get to because of the time requirement of the show. With that in mind, let's get to the market recap and see how things played out today. The S&P 500 finishing just slightly below 5,400. Now, earlier in the day, we got almost to around 5,450, and that first 30 minutes of trading looked really darn encouraging. This was after the sell-off in the last hour of Monday's session. So a Tuesday open basically pushing higher, just out of the open, kind of started to feel pretty interesting. Very quickly, we came back to test yesterday's close, and from there, we sort of bounced around. And at the end of the day, this was, I don't want to say a total nothing burger, because there were some movements underneath the hood, which we need to talk about. Technology doing pretty well. Stocks like Palantir certainly looking like they are, sort of getting more of a vibe back, getting more mojo back. However, the major averages not really pushing higher. And in the end, essentially an unchanged day for the S&P and the NASDAQ. So the S&P just finishing below 5,400. That's down 0.2%. The NASDAQ composite basically flat for the day. We're talking 8 points from Monday's close to Tuesday's close. That's less than 1% down. So essentially unchanged. The Dow down about 0.4%. Mid caps and small caps slight down day. So this is really sort of a wait and see day. We'll see. I didn't see any big headlines about big tariff changes. Maybe this is what happens when the market's sort of licking its wounds and just sort of taking a breath or I guess trying to catch our breath after the flurry of headlines over the last week or two. We could use a nothing burger kind of day every once in a while. The VIX did indeed move lower here, ended up right around 30, and that's coming down from an intraday peak around 35 on Monday's session. So, I guess, is this high or low volatility? It depends on your look back period, right? It depends on your frame of reference. If you're talking about the last couple of weeks, a VIX of 30 is super low compared to like 45, 50 plus that we saw not too long ago. If you're comparing it to the last couple of years, 30 is pretty high relative to, most historical standards, right? So, a VIX above like 29 is sort of the red flag. This is a big corrective move type of level. We're still above there, even with the pullback that we've seen in the VIX. So, for now, volatility coming down, but still elevated. The MOVE index, which measures volatility in the bond markets, coming down, but still higher than average. So, it's sort of like less bad and not more good, if that makes sense, right? So still elevated, but not as elevated. That's better. We're going in the right direction, but we're still not to the point where we're in a low volatility environment. Remember, and again, I can't stress enough, the podcast interview we did with Jay Soloff, sort of like a VIX 101, what the VIX actually measures. And when you think of what the VIX is actually telling you in terms of the expected daily percentage move on the S&P, even though the VIX comes down from like 50 to 40 to 30, that's still the market pricing in huge swings. So a day like today where we had minimal move is a huge outlier relative to what the VIX is actually pricing in, which is significant moves to the upside or the downside, right? It's not direction or path dependent, as we would say. All right, looking at the other asset classes here, we can see the bond markets actually rallying a little bit, right? So the 10-year, the long bond yield, the long bond ETF, the TLT, was up about 1/3%. This has been one of the most concerning things that we've seen. And again, I've read and listened to more than I really want to about tariffs and what's happening. I mean, I don't really enjoy politics that much. In this world and in this environment, you have to understand how, because there's so many market impact issues we have to think about. But a lot of the commentary and thoughts I've heard about is really the change in policy that we saw, going into this week was most likely related, and really was last Wednesday, right, when we had the announcement after the close, probably because the fixed income market was really showing signs of distress, right? And so if you look, the TLT was a bit higher today, but the general trend has been lower, but rates have been going higher, and that's counterintuitive versus what normally happens when market conditions are getting pretty rough. Sort of the standard markets are in trouble kind of playbook would be bonds rally, the dollar rallies because investors from all over are converting to US dollars to buy US Treasury bonds, which are a very stable, essentially a risk-free asset as close as you can get. And that's how you ride things out. And we've been observing a weaker dollar and weaker bond prices. So when that is happening at a time when economic signals, certainly consumer-related signals, seem less robust, that's a concern, right? So you're seeing weaker consumer data, weaker bond prices, weaker dollar. That's not a good sign. Today, bit of a bounce here, right? So bond prices bouncing higher, rates coming down a little bit. That's kind of what you'd want to see, I think. The dollar moving higher, which is good because the weaker dollar, I think, has been pretty big concern. Now, again, this is one day. The trend is still fairly concerning, I would say, with rates remaining fairly elevated relative to what you'd expect, given the conditions in other risk assets. Looking here at the commodity markets, you can see the DBC was down slightly. It wasn't a big day for commodities either, but gold continued to push new all-time highs. The GLD up above 297 at the close. It's up about 0.5%. Silver prices up slightly. Crude oil, natural gas, both down today. Energy was kind of in the middle of the list on the sector weightings. Looking at the cryptocurrency market, really sold off today. This is one of those where there's a bit of a disconnection between equities, which essentially were choppy, sloppy sideways, versus cryptocurrencies, which overall were kind of deep in the red, right? Bitcoin trended lower through the course of the day. Ether still trending lower. Bitcoin's currently around 84,000. That's only down around 0.7% from the end of the day yesterday. But you can see we got up to above 86,000 earlier in the day. And then during the equity session, really getting dinged pretty good here. Bit of a change here. The cryptocurrencies and stocks have been trading together for a while now. So this disconnection all of a sudden stands out to me because they've been very, I feel like the correlation between the two has been fairly strong recently. Most days we're kind of looking at the two charts and they're following very similar trajectories. Here you're almost getting cryptocurrencies selling off more than stocks. I mean, I don't know if you call that a leading indicator, is to say there's a risk-off vibe, less speculative pressures, and it's just not reflected in equities. Maybe you make that argument. I don't know if I'm ready to make that particular cause-effect kind of relationship. It's something we'll certainly continue to follow. Looking at the 11 S&P sectors, it wasn't a great day, right? So only 4 of the S&P sectors were up. Technology was the best performer, still only up about 1/3%. Financials up about 1/4%. Same for communication services. So, again, this is as a bunch of banks are reporting earnings. So, I mean, if you're bullish here, I probably want to see the XLF up a lot more than this as big banks are reporting earnings. These are the big weights in the XLF. After Berkshire Hathaway, which is the biggest, you get into names like JP Morgan, Bank of America, Citigroup, Wells Fargo types of stocks. And some of them had a decent day, but the XLF still not great. So not a bad day again for some of those sectors, but not up a lot. This is sort of flat. Real estate and utilities, the two, fairly defensive sectors, kind of right in the middle. On the downside, consumer staples, the worst performer, which is one of the more defensive sectors, down 0.8%. Materials down 0.8. Consumer discretionary down 0.7. So what was new and different today? I mean, at this point, it was sort of a quiet day. And again, this feels remarkably boring after all the days where we're struggling to keep up with all of these sudden movements. This is more what a normal market should do on an average Tuesday. So we'll see. But for now, I mean, kind of a quiet day. Is this the calm before the storm? That's what I'm always afraid of with something like this. All right, looking at the breadth conditions, it's actually changed quite a bit through the course of the day. At one point, this is out of the open, the breadth looked remarkably strong, but through the course of the day, kind of leveling off. By the way, latest podcast episode, just recorded it a couple hours ago. We'll probably get it out to you tomorrow morning. It was with Vince Randazzo. Vince is the founder of a firm called ViewRight Advisors, based in Florida, on the east coast of Florida. And he used to work with Paul Desmond of Lowry Research, a famous technical analyst, Rick Bensinger at Morgan Stanley, a famous technical analyst there. And Vince is fantastic with breadth, very systematic approach to analyzing price and breadth data. Really good conversation. I think a perfect kind of calm assessment of market conditions given all the disruption that we've seen. So look for that here in the next. Hopefully tomorrow morning, you'll get that latest episode of the Market Misbehavior podcast. All right, looking at the breadth here just a little more closely. On the New York Stock Exchange, 52% up, 46% down. That's essentially an even day. The S&P skewing more negative, you can see, right? So 60% down, 39% up. So still not horrible, but more, certainly more down than up. Again, relatively flat day compared to these big binary days we've seen in breadth conditions previously. All right, looking at the leading growth names, what we call the Magnificent Seven and Friends, Netflix continuing to differentiate itself. I mean, out of this basket of stocks, by far the most constructive technical configuration, I think, and not even a contest, would be Netflix, which is arguably a pretty good chart, and relative to others, an exceptionally good chart, but on an average day, pretty decent chart here. 4.8% to the upside. NVIDIA number two, up 1.4%. Tesla finishing slightly higher, less than 1% on the downside. Meta still trying to get above that 200-day moving average. Not going to do it today, being down 1.9%. Alphabet down 1.7%. Amazon down 1.4%. So, Netflix, the big winner today. NVIDIA, something to watch because semiconductors have not been particularly strong. But some of these key names testing moving averages, testing the 200-day, Amazon and Meta in particular, getting dinged today. All right, let's go on to the market carpet. As a reminder, those of you tuning in live, I can see questions you're putting in on YouTube, on X, on LinkedIn, on Facebook. So keep them coming. Love the commentary as we're going here, folks. And we'll try to get to a question or two at the end of the episode. Anything we don't get to, please make sure you put your questions in. We'll put them in the mailbag, and we hand select 5 or 6 questions every Friday to dig into a little more deeply. So I appreciate good questions all along the way. Might be able to get to them on Friday's episode. Kind of a mixed results kind of day, right? When you look at the market carpet here, this is one of those days when the market's neutral. And sort of flat for the day, when the major averages are essentially sideways, it's really helpful to see the outliers, right? I think the names that are up a lot or down a lot almost jump off the page of you. That's why I love this kind of visualization. A couple, sort of one is just look at the entire, quilt here, right? This entire landscape. What's the general feel? Is it more red? Is it more green? Is it more neutral? Is it modeled? I would say today is more of a modeled day where the average probably averages out to a neutral amber color, but something's up a lot, something's down a lot. Number two, look for like sector and group themes. Where do you see clusters of green or red that would tell you something was happening in one place or another? And then finally, look for opportunistic individual names with significant movements. Sort of the outlier check. So, general assessment, very mixed day again, right? Kind of a neutral day overall. Apple's kind of, flat for the day. And you see a lot of that Apple color all around the heat map today. What sort of themes do we see? Certainly weakness in some healthcare, weakness in consumer staples, weakness in materials are three that jump out at me, with particular sectors with more skewing red than green. Another thing I would say with just sort of these random names having decent up days. And what's interesting is when the benchmarks are flat, any stocks that are up a decent amount, that tells you it's not just the market, right? A lot of times when stocks are up, but everything else is up, you sort of write it off as well. It's just a rising tide lifts all boats. It's all stocks kind of drifting higher, and this is just along for the ride. If anything was up today, something's up, right? Something's happening. Either expectations are changing. We have some catalyst. And again, necessarily this visualization, rarely tells you why things are moving, but it helps you focus on where your attention should be. And that's why I love this sort of visualization. I learned a long time ago, technical analysis and being a successful investor using technical analysis isn't about analyzing a particular chart perfectly, right? I mean, and it's good to do that, but the bigger challenge is making sure you're looking at the right chart in the first place, right? It's using scans and alerts and visualizations like this that help you look at hundreds and hundreds of stocks and make sure with your limited attention during the day that you're focusing on where there could be an opportunity. So where do we see those sorts of movements? So what jumps off to me, Meta and Alphabet down a lot more than I'd want to see. Amazon down as well, kind of stands out to me. Palantir, CrowdStrike, HPE. These are names within technology doing way better than average, a little less, but still good. Palo Alto, ServiceNow, Fortinet. These are names that are up a decent amount, over 2% today on a day when the benchmarks are flat. That's kind of interesting. In the financial sector, of course, we have some earnings related names. Bank of America, Wells Fargo, both up today. Bank of America up almost 4%, which is a pretty impressive rally. Through the remainder of this week, by the way, we get through sort of the money center banks and then into more of the regional banks, names like Huntington, Key. These are names that'll be on our list to review as we get through the latest earnings report. I think that's it for the heat map. Again, I when I'm looking at a day and just trying to make sense of it, I love this as a starting point, and then drill into some of those individual names that are the brightest colors. That tells you something's up that you probably want to be aware of. All right, looking at the charts here, and then we'll get to a couple questions, and we'll call it an evening. The daily chart of the S&P 500. Again, I mean, the two things I would say about this chart. Number one, that was an incredible rally off of the low from last Wednesday. So starting, last Wednesday through where we're at today, overall an incredible counter trend rally. I think if there's anything, there are a number of things that concern me about this chart still. But I would say, remember, I think when you take a step back here, we're still making lower lows and lower highs, and that's what concerns me. Here's that big move higher. This was last Wednesday when the announcement comes out midday. We have a huge spike. That's been the high for the last week and a half. So off of the low, the day that those tariffs were unwound has now been the high. From that moment on, we've not overtaken that. So what that tells me, at least for now, until proven otherwise, that big move was an instant reaction to arguably ridiculous levels of tariffs announced were dialed back, right? And so the market takes that as a huge win because it took the announcement as a huge negative. So they're going away. That's a big positive. But it certainly feels like the market reacted as if they're all going away. And if you actually read the details about the policies, they're not going away. They're just delayed and or still there, just in a scaled down version. I don't think we're hearing the last headline about tariffs or some sort of trade war related headline. And I don't see how that doesn't weigh on the markets here. You're seeing that the last couple sessions, right? Overall, not big directional moves, but we're closing below the open and we're not really seeing accumulation, beyond what would just be sort of normal amounts. 5,500 is still that level I have an alert set on. Breaking above 5,500, breaking above this trend line. Once we start doing that, you'll hear my tone change. And if you're asking about why I'm not more super excited about this bounce, and again, I read a lot of commentary. I talk to a lot of my peers. I know plenty of people who are super bulled up because of this low. And I hear the argument. I get it. My goal as a trend follower is to try to assess the longer trend. I haven't seen enough to tell me that the trends are better. I'm seeing my evidence tells me that we're still, there's still more to prove. And so for me, I'm happy kind of patiently wait for that evidence to arrive. Breaking above this trend line, breaking above 5,500, that's where I think you can't fight it as much, and you have to start reconsidering how defensive you want to be, how much cash you want on the sidelines if we're going to see a sustained rally above that level. We're not there yet. We'll see if earnings are a way to accelerate to the upside. We'll see. Other things to think about: the McClellan oscillator. This is as of yesterday's close, by the way. I didn't have it updated in time to show on the show yesterday, but I was guessing it would probably be the case given what we saw in the benchmarks. But the McClellan oscillator did flip back above zero. It's been below zero for pretty much most of the last 3 weeks. We had a brief hiccup above the zero level right at the beginning of April. Yesterday we broke above. We'll see if we remain above there. It really depends on the data because we're very close to the zero level, but something to watch, right? I think the McClellan oscillator sitting above zero definitely confirms we're in at least a counter trend rally that has some legs. Again, the move back below zero is usually a sign that downtrend may be continuing. So a short-term measure of breadth. We've got plenty of longer-term breadth measures that we track and that we highlight on the show, but that's something I would be looking at there. For now, encouraging to see the McClellan oscillator more positive. Boy, look at the volume here, and I'll zoom in a little bit because I meant to zoom in a little bit more before I stopped it. If you look at, that's a little too much. If you look at the chart of the S&P 500, this is the SPY that we're looking at. Look at the volume in the sell-off here, right? So this is the February peak. There's the low second week in March, the bounce up to late March, and then the acceleration downwards on the tariff announcement. Chicken money flow turns back below the zero level. Here's that volume on that sell-off period. Here's the huge volume on the, I don't know, the last Wednesday, whatever we want to call that, the tariff wind back day, I guess. But then from there on this drift higher, anemic volume, right? Lower and lower volume. So if this is the big recovery we've all been waiting for, I don't know about you, I'd want to see a lot more volume indicating that there's optimism, indicating that there's more aggressive positions being taken. I'm not seeing that. This looks more like investors staying on the sidelines and just wanting to wait and see how things play out. I mean, there's just so much uncertainty. And if you're a professional money manager taking aggressive positions during period of uncertainty is not how you survive these kind of markets very well, because if you're right, that's great. But if you're wrong, you're done. There's career risk in being on the wrong side of some of these moves. So it's a much more well documented and well followed approach to what's called lower your beta, which means you basically reduce exposure to the markets. You get into cash and other cash-like things and stable stores of value, and just try to get as defensive as you can. If you have to own equities, you get into defensive sectors and try to ride it out. But I'm seeing the market bounce on lighter volume, and that could change. We could see an improvement in that, but I'm not really seeing that big accumulation side. The biggest volume we've seen was in the sell-off going into that low. So I think the volume picture is still not super bullish yet by what I'm seeing. All right, let's continue on here. Sorry, I made this. There we go. All right, back to some currencies and commodities. We talked about the dollar. Here's the chart of the dollar here. So up slightly today, but the problem is the trend in the dollar has been very much down. After the second week in January, the trend has been down, right? Lower highs, lower lows. So that means going into the market peak, we have a weaker dollar. Going through this market sell-off, we have a weaker dollar. During this recovery over the last week and a half, we have kind of a weaker dollar. So you're just not seeing a big strengthening in the dollar. And that's, again, it's concerning because what that implies is that people that have traditionally thought of the U.S. as a safe place to be are certainly not seeming to think that way at this particular moment. I don't know who all those actors are and what their motivations are, but the data is telling me the dollar should be strengthening if this is a kind of classic correction, and it's not. And the concern is if all of a sudden that leads to further declines, right? If there's a lack of confidence in the U.S. market in a way we've not seen in quite some time. I think that's the risk here that we're all trying to get our head around. Crude oil bouncing off of the lows along with stocks, not a huge recovery yet. It is above $60 a barrel, so certainly something to continue to watch. But for now, we'll wait. Gold right around new all-time highs here. We made a new high on Friday and the last couple of days right around there. That's above $3,200 an ounce for the first time in history, continuing to be a strong chart heading upwards. Had a question on yesterday's show, I think, about other countries, other global markets, and what they were looking at. And yeah, shame on me for not showing some of these more often. I have them on a list that I review regularly, but just rarely make the time to review them on the show. Why don't we go there? Germany and other markets, right, have been, in so many ways outperforming the U.S. market. You can see on the bottom, this is the EWG versus the SPY. So this isn't the DAX index, which is the main German benchmark, because that's denominated in euros. And so we're looking at it in US dollar terms by looking at a US ETF. And that's just, for me, when most of the people that I work with, high net worth individuals, self-directed investors, financial advisors, if they're getting exposure to other markets, it's usually through ETFs like the EWG. It's not, doing a local currency thing in Germany. So that's why I use these. You'll get somewhat different reads looking at like the DAX or the Nikkei, but I found the iShares ETFs are an easy way of tracking global indexes and how they relate back to the U.S. markets. Look how many times the EWG has tested its 200-day moving average going back over the last 12 months. So over the last week and a half, we had the gap lower as tariffs were announced, as they recover, bouncing back higher. Again, bouncing off of the 200-day is pretty encouraging. Problem I have with the U.S. market, it did not bounce off the 200-day. It actually broke it and has remained below that level. But the relative strength is still quite good. So given a choice, do you want to own Germany or the U.S.? I'd probably own Germany at this point, given the fact that it's in a much more constructive technical structure, right? It's above two upward sloping moving averages. That's not something I can say about the S&P 500 or the NASDAQ. China, this is the FXI that we're looking at, also bouncing off of the 200-day moving average. What's interesting is on that gap lower, it actually traded right down to around 29, and that's where the FXI, that is, bounced in late November. That's where it bounced in mid-January, kind of right back to that same level as we're reaching an oversold condition. So not as consistent of an outperformer as you see from like the EWG and other developed European markets, but certainly starting to bounce a little bit. What I'm looking at on the chart of the FXI on a tactical time frame is that we're right up to that gap here, right? If you look at the gap from around 35 down to around 33.50, which was that downside gap last week, we've actually traded right back up to the lower end of that gap range. And so ranges like that, I usually think of as a support or resistance range. What I meant to say was gaps. I just sort of usually draw a triangle there, a rectangle there, and track that range and expect resistance. We're kind of right up to that point where a counter trend bounce most likely stalls out. So I think this one's in wait and see mode after the V bottom off of the 200-day moving average. This is the chart of Japan. It's interesting how the bounce we saw over the last week lined up okay, pretty well, we'll say, with the August 24 lows. I'm highlighting the closes here just to show how that lines up with the closes that we saw there. Now Japan is rallying up to a perfectly flat 200-day moving average. The RSI is dead even at 50. I think this is neither bullish nor bearish. I think that the spike that you had off of the lows, pretty encouraging. That's a 10+% rally off of that swing low. But now we're kind of right at the midpoint. So I think you need to wait and see. Pushing above the 200-day moving average on improving momentum makes that a pretty compelling chart with the opportunity to retest the previous highs. But Japan as an ETF has been, incredibly sideways. So doing better than the US, but not that good on absolute terms. All right, this was the chart I promised we would review every day this week. So as promised, here it is. 3 key growth names with their 200-day moving average in play. And the question is, will they reclaim their 200-day moving averages? For today, the answer yet again is no. Meta in the top panel pulling back a little bit more today, one of the worst performers out of this basket of leading growth names. Amazon, probably second worst, pulling back a little bit as well, just below 180. Tesla, number 3. I mean, draw a straight line from early March to where we're at today. I mean, we've chopped around, but the market's telling you Tesla's worth about 250, no more, no less. And until there's a catalyst to break out of that range, I think that's a wait and see chart at best. Now, Palantir is starting to improve quite a bit. This looks like a pretty normal basic chart, but these are huge percentage swings that we're dealing with here to keep in mind. So these are big moves that we're dealing with, even though they look like small moves on the chart because of the appreciation that we've seen over the last 2 years here. Peak around 125, intraday low around 66. We're back up to around 98. We're right up to that $100 level. Big round numbers often are super meaningful. We can see the gap here. Actually, the top end of that gap is right around 100. So that's kind of right where we're at with today's high. So I think pushing above $100 makes this a pretty compelling chart. Unless we can do that, I'm sort of wait and see mode. So we're testing short-term resistance. I think Palantir very close to becoming a very constructive chart yet again. It's been in wait and see mode as we've had a significant pullback with about a 50% loss from that February peak to that low in April. Pretty close to looking like an all clear from a technical perspective for now. Netflix very closer to Palantir, and just like Palantir touching 100, Netflix testing 1,000. Now, Netflix is reporting earnings later this week. That's on Thursday, I want to say. Here it is. Yeah, Thursday on the 17th. So for now, trading up to 1,000, that is, I think getting back above 1,000, Netflix is a great chart. Compared to the other Magnificent Seven stocks, Netflix is by far the best because it's the only one that is currently above the 58-day and 200-day moving average. The only one where the 200-day is just consistently sloping higher, and it looks like a decent chart coming out of a brief pullback. Most of the other names look a lot less constructive. So I think Netflix is a pretty good one. This could be a great earnings story on Thursday, but boy, an earnings miss as it's testing 1,000 could be, disastrous is a good word, I would say, probably to describe that. And this is what concerns me about this market, given the general sentiment. I mean, most investors kind of shocked and shell shocked, I guess, after the last couple of weeks. Company misses earnings. Like, I don't know how bad it sells off, but it can't be good because we're all just waiting for the next thing. And if a big headline is Netflix, whatever negative headline comes out of it, that's a problem, I think. CrowdStrike, by the way, similar to Netflix, similar to Palantir, they're all testing these swing highs from March. So these are the more constructive charts out there, right? I mean, you have a group of stocks that still look fantastic, like Kroger, names that we've highlighted, tobacco names, just in these nice consistent uptrends, like nothing else is going on. Then you have names like CrowdStrike and Palantir that got beaten down very quickly, but now we're actually starting to bounce a little bit. And that's where I think investors start to believe when we start to get above those swing highs. So I think CrowdStrike above 400 becomes a pretty compelling chart again. All right, two more to finish off with. Bank of America here. We can see what we have to label as a shooting star candle, right? So we have the gap lower on B of A, and then another gap down. Those two gaps from last week. Then we chop around. Then going into this week, we're gapping higher a couple days. Today we have earnings. We gap up. We open around what we'll call it 37 and change. We trade up to almost 39, but by the close, we're back down to 38. It's called the shooting star candle. Suggests the next 1 to 3 bars are most likely lower. So again, that's rough when you have a good reaction to earnings. But what this tells you is during the day, traders are selling that strength, right? So there's not accumulation happening. There's people thrilled to cash out at a higher level and then get out of the way. At least is how I would read the short-term signals. So again, these intraday sell-offs that we're seeing are a bit of a concern. Finally, Ross Stores. Ross Stores is one of those consumer stocks testing the 200-day moving average from below. Hit it yesterday, didn't quite close above it, but very close to doing so today, trading back down from the 200-day moving average. Similar to some of the FANG stocks we talked about. Chart like this getting above the 200-day is super encouraging. Chart like this unable to get above that long-term trend barometer, not encouraging. All right, let's take a look at a question or two, and we'll be done. Let's see. Titus Ryder, thanks as always for watching, my friend. You said, do you consistently trade the same group of stocks? If yes, approximately what percentage are rinse and repeat versus new stocks? Yeah, this may be a question you intended for others in the chat, and I see some responses in there. I appreciate you guys answering. For me personally, it's a mix. I sort of there, and this is something I learned from my Fidelity days. a lot of the money managers there were analysts at one point. So they covered one space very deeply. So they would have a small group of names, either a sector or two, or particular types of stocks that they knew so well that was sort of like their active portfolio, because they knew them so deeply. Other things would have other motivations, but that was sort of a basket of stocks they always seem to have a position in, and they're kind of trading around, and because they really had thoughtful ways of differentiating the different names in there. For me, my general approach with my own portfolios is a core position, which is driven on a momentum-based model that I try desperately to just not use my brain, and just use my brain to follow the model and do what it's telling me and not overthink it. Then I have a discretionary part of portfolios that I run where I'm more actively trading them. And that really is go anywhere. I love being untethered and being able to go into different places. That was a part of my portfolio I could never have when I was working at larger firms, because were so restricted because of compliance reasons. So the moment I was out on my own and could trade whatever I wanted, whenever I wanted, I very happily devoted a part of my portfolio to doing that. So for me, I mean, there's certainly names that I follow the most closely, and I analyze the S&P 500 stocks deeply, and I follow them closely. A lot of the charts, like if you cover the tickers, I probably would be able to guess at least the sector, probably the group, and maybe the ticker, depending on certainly on the S&P 100 and maybe the 500 as well. So I rarely go out of the S&P 500 just because I don't feel like I necessarily have an edge on there. So that's kind of how I would think about it. Curious how others would answer that same question. And thanks for that. What else? Here we go. Yeah, so I love this. Robert, David sounds bearish. You're probably right. And again, what's so funny is my goal is to not imply a perspective. I mean, I see my role primarily is to provide context, help you understand what's going on, to sort of help you understand how we can use charts to think about movements and highlight key actionable points that I think are relevant for most investors that are actively managing a portfolio. For me, again, again, the interview with Vince Randazzo, I hope you'll enjoy, because he has a very similar way of thinking about market analysis that I do. It starts with, it really should be driven by a systematic approach. That's why the moment I, sort of was really putting together my own toolkit, I was really intrigued by having a model of sorts. And there are others that I used to follow. Ned Davis had a big Mo model. Luthold Research has a call it the Major Trend Index, I want to say. Combining a bunch of different indicators. I love that idea of just having a basic market position, a market call based on systematic analysis of the evidence. But then you have a subjective overlay on top of that, where you're looking at conditions of breadth and sentiment, more anecdotal evidence, and combining it with the model to sort of paint an overall picture of what we're seeing. So for me, a market trend model is a core part of what I do. This is the first chart I look at every day. This morning, I fired up the laptop. I looked at this chart just to remind myself, okay, before I think of anything else, the long-term trend has been bullish for the last almost 2 years, but we're very close to the model telling me that the long-term trend is no longer bullish. That's something I want to keep in mind. The medium-term model for me turned negative at the end of February, which means in my core, my active positioning, I want to be defensive right now, because when the medium-term model is negative, that means generally we're in a risk off, and I want to be taking risk off the table. And the short-term model has been bearish since the second week in February, which tells me that we're more likely seeing down days than up days until proven otherwise, or at least we've not seen enough up days to significantly change the short-term trend. So that's what defines my process. When go back to episodes back here, and you'll hear a very different tone where I'm talking about, hey, conditions are great, market trend is good, long and strong, let's follow the trends, and we're just trying to find ways to do it. In this kind of environment, I think you have to be more cautious and more defensive. My whole tone probably changes, but I'll probably keep smiling no matter what's happening in the markets. That's something I've learned over a career of watching all sorts of upswings and downswings. Man, you got to stay centered and keep a good attitude. Otherwise, you're finished. Folks, that'll do it for today. Thank you so much for joining me here on Chart This with Dave Keller. It's a pleasure to do the show. I appreciate all the thoughtful questions. Anything we didn't get to, we'll put it in the mailbag and hopefully get to on Friday's episode. For now, have a fantastic evening. And remember, it's always a good time to own good charts. Take care, folks.